Welcome guys, welcome to this another episode of Funds Ki Baat with ICICI Direct. Today we have Mr. Aashish Somaiyaa. Aashish Somaiyaa is the CEO and the ED at Whiteoak Capital. It's an absolute pleasure to host you, Aashish.
Thank you.
Before we get into the market talks and all the stuff, can you tell us a bit about your journey? Because it's been through various AMCs and finally you are at Whiteoak Capital, so a bit for our users.
Yeah, sure. So I joined, it was that time called Prudential ICICI Mutual Fund. Now it's called ICICI Prudential Mutual Fund. I joined them as a trainee in 1999. And then, for pretty much the early part of my career over a couple of stints, I worked with them till about 2012.
Okay.
At the end of 2012, I was head of sales at ICICI Prudential Mutual Fund. And then I moved on. I joined Motilal Oswal Asset Management Company as their managing director. So say just short of 8 years, till about September 2020, I was CEO at Motilal Oswal. And from there, I joined Whiteoak Capital as the CEO. So yeah, I've been around in the industry for about, say, 23, 24 years.
That's it.
Yeah, and I've never worked in any industry other than this. So this is all I know.
So another question that comes up is, this is what you wanted to do since your college days, or it changed midway?
No, not really. If you ask me, whenever you ask somebody about their journey or about their career, usually people give answers which are like perfect. See, I knew I wanted to do this, so I went there and then this happened. I don't think it's ever that way. It is always, series of coincidences or, sometimes some opportunities come up and then you take a call. So no, I can't say that this is what I always wanted to do, but yeah, I can say that I loved where I ended up being.
Yeah.
Right. Because from college, after my B school, this is the first job I took up, and I continued with that. So yeah, I think because I enjoyed. I don't think it was always planned to be this way.
Okay. So since this episode is Funds Ki Baat and Whiteoak Capital is a very emerging fund.
Yeah.
So can you just elaborate about the offerings that Whiteoak Capital has for our users? Then we can move ahead with other questions.
Yeah, so Whiteoak as an entity has been around since June 2017. It's founded by my colleague. His name is Prashant Khemka. And prior to founding Whiteoak, Prashant used to be Chief Investment Officer at Goldman Sachs Asset Management. He worked there for 17 years. First 6 years, he was a portfolio manager of US equities. 2006, he came to India and he helped Goldman Sachs to set up their India equity offerings. And then along the way from 2013 onwards, not just India, he was also CIO for global emerging markets. So he set up Whiteoak in 2017. As we speak, about $6.5 million of assets. Lesser known fact, out of the 6.5 million, over 4 million, almost 4.5 million is global assets that we manage, on behalf of global investors investing into India. So sovereign funds, pension funds. We have our own mutual funds domiciled in Europe, Mauritius, and also one listed on London Stock Exchange. So we are one of the larger, in the last 3-4 years, we are one of the large foreign portfolio investors investing into India. I am responsible for the domestic business. I think your question is more pertaining to that.
Yeah.
So within India domestic business, we are about $2 billion. We manage discretionary PMS, we manage AIFs. And last year, we also launched our own mutual fund.
Okay.
So as far as mutual funds are concerned, we are only into equity and hybrid. So now we have a flexi cap, mid cap, large cap, balance advantage, multi-asset. So a plethora of retail products basically.
Absolutely. So coming to domestic markets, right now Nifty is in the all-time high territory. And at this juncture, it's very difficult for somebody who's missed this rally, like 16,800 to 19,000, around almost 20,000 that we have scaled. And many people have missed this rally because at that time in March, there was a lot of pessimism around the market. So someone who's looking to enter the market at this level, what would be your advice for a new investor who wants to ride this rally?
See, one thing you should always remember that all past corrections look like missed opportunities.
Yes.
Except this one. What it means is that in March 2023, I think Nifty went as low as 16,700 or some such number.
Yeah.
But before that it was 19,900 in November 22. Right? 18,900, sorry.
Yeah.
When it was 18,900, it was an all-time high.
Yeah.
So everybody would have thought, let it come down, I'll invest. It went down to 16,700 or whatever.
Yeah.
They would have said, no, but it can become 15,000.
Yeah.
So they didn't invest. So what happens is that all-time high is a way of life, right? Right now you have an all-time high, like you said, but the previous all-time high, like I reminded you, was November 22.
Yeah.
Before that, the all-time high was October 21.
Yeah.
Before that, again, November 20, and before that, Feb 20, and so on.
Yes.
You can go back in time. So every 15 to 18 months on an average, market makes an all-time high. In any given year, there is a good chance there will be an all-time high.
Yeah.
And in any given year, there will be a good chance that you will get one correction of about 15 to 20%. So I think that 10, 15, 20% corrections are par for course, all-time highs are par for course. It's just the human thing that, if I invested today, then from tomorrow market should go up. But market doesn't know you invested today.
Absolutely.
So you can't do much.
Absolutely. So, Aashish, this is perfect. But suppose, I'm again coming back to that question, because how do I allocate my funds into different as large cap, mid cap or small cap at this level in that terms?
No, I think, there are some occasions when you feel that a particular part of the market is starkly overvalued or a particular part of the market is relatively cheap. I don't think right now there is any such thing. I personally feel that right now you should be in a well-balanced, multi-cap kind of product.
Okay.
Which is like we run our flexi-cap fund like a multi-cap. But broadly what I'm talking about is 50-60% large cap and say 30-40% mid and small cap. I'll tell you the reason why. Most people think that small and mid cap has run up a lot. Well, yes, last 3 months it has run up a lot. But it's still close to its all-time high, which is where the Nifty is also close to its all-time high. And the current movement in the market is absolutely broad-based. I don't find any sector which is way away from its or from its high, and I don't find any segment of the market which is way off the charts. So it's a broad-based participation. Even if you see, let's say you take FY24 earnings projection, you will find that it's reasonably well spread out.
Yeah.
So I think market is broad. And I don't think that you should be in favor of any sector or market cap. You should be in a diversified fund, which is
across caps, basically.
Yes, absolutely.
Aashish, last time's the final quarter's earning, you had spoken about a qualitative growth versus a quantitative growth about the companies coming out of the earnings here.
Yeah.
We are in the earnings season right now, and major IT companies and banking have actually released their results. Yeah. So what is your take on this first quarter's results?
Yes, I'll contextualize why I spoke about that quality and quantity thing. Look, it's like this. If you see last year, at least for the first 3 quarters, that in the beginning of 2022, there was a war.
Yeah.
And after the war, all of a sudden, oil, metal, energy, commodities, all these prices really flared up.
Yeah.
And some of these sectors had obviously a big bump up in their earnings. On the other hand, a lot of sectors for which these things are inputs, they actually kind of showed a compression in margins. So, cyclicals are cyclicals. You know that there'll be once in a while, there's this massive bump up which comes. That's what I meant, that, quantitatively, it must have been a big jump in their earnings. But if I take the overall market, sustainability is what I meant by the quality aspect of it. I think so this year, what we are noticing is that the spread of earnings, it will be more broad, it will be more broader. You will find more sectors participating in double-digit earnings growth. And that's what I meant, that you will have better quality. Not just a EPS growth, more qualitative.
Exactly.
Spread. So this year, things probably will be better than last year. That is one. Second, banks, of course, it was anticipated that banks would have good earnings. And IT, definitely people are a bit circumspect, because you want to see the fallout. So I think we have to see how the year goes. But net, I think this year on the spread of earnings and breadth of market is going to be better than last year.
Absolutely. You spoke about banking and you spoke about IT, the two spoken sector, because IT has been correcting since the start of CY 2022. And banking, especially in the last quarter earning, a lot of management calls happened that we'll see a peak, like NIM, net interest margin, will peak out and we'll see a contraction in NIM going ahead. So IT has come, your take on these two sectors specifically, and first banking and then we'll come to IT.
See, IT, I think we are not significantly overweight or underweight. We are in line with the market broadly, because of course we manage our funds ultimately to beat BSE 500. So it's not like we are agnostic to benchmark, or it's not like we are managing for absolute return. Hence, I'm saying on relative terms, we are in line with the benchmark. We don't have. But yes, if you see the composition, we prefer, or we see our team seems to be preferring mid-cap IT rather than the big ones.
Okay.
So we were any which way underweight on the big ones. And we are more overweight in some of the mid-cap IT names. That is one. Second, I think is that, whatever decline in margins or poor performance that is being spoken about, I think very quickly people are jumping to conclusions about automation and the usage of AI and ChatGPT and those kinds of things. I think we are open-minded about it. We'll watch how it progresses. Your second point about banking. If you really ask me, banking has still another year or two. See, because one of the other things is after a long time you're seeing credit offtake.
Yeah.
After a long time you're seeing possibility of a good capex cycle.
Yeah.
Right. So, and after a long time, you're seeing banking sector absolutely in the pink of health, which means that they can participate in the...
Absolutely.
See, look, in the, if you see 2016-17, banking sector was in kind of distress.
Yeah.
And all you could see was many banks were just passing on money to NBFCs, and NBFCs were fulfilling the whole credit cycle.
Yes.
And then you saw what happened in 2019-20. But my sense is this time around, banks are in the pink of health and they will participate. And I think they will benefit from the credit growth and the uptick in economic activity. So I think this is sustainable. I mean, and of course, you have to see over time how it plays out. But I would say that the enthusiasm or the positivity is definitely sustainable.
Absolutely. Coming to banking, in this banking rally, PSU banks have been a major ones which have moved up, like stocks like SBI, which nobody used to touch, and today SBI is trading about 600. So in terms of private banks and PSU banks, what would be your, where will you place your bets going ahead?
See, look at it this way that, ultimately we have to look at consistency and we have to look at sustainability.
Yeah.
What we have found, unfortunately, over long periods of time is that there is a huge cyclicality element in the performance of state-owned banks.
Yeah.
Correct. Not to say that some of the private banks haven't had their fair share of problems, but the fact is that if you were to generalize, take the liberty of generalizing, then we have seen that more cyclicality and more interference in the functioning of state-owned banks. On the other hand, if you see private sector banks, the long trend in our country has been that PSU banks have been losing market share to the private sector banks. So now you look at periods like 2016, 17, 18, 19, and maybe even 20.
Yeah.
I remember distinctly that in March 2020, system level credit growth was zero. So imagine when system level credit growth is zero and still a private sector bank or a private NBFC grows at double digits. Where is that growth coming from? It's coming because state-owned enterprises are losing market share to the private. So one is that when there is a growth cycle, any which way banks will participate. But second is, even when there is a lean cycle, still there is a migration of market share, right? So that would make you understand that ultimately private sector banks' performance has been, the growth trajectory and performance has been a lot more sustainable than what it has been for the public sector
banks.
And hence, we seem to be more overweight, or, our analysts or our team seems to be more in favor of the private sector.
Okay. Two sectors I've covered. I don't want to get into a lot of sectors, but I'll ask your sector for coming year, any sector that one can focus on, maybe a pharma or an automobile or something.
Yeah, so, definitely we are. So there are 2 or 3 areas where we are overweight. One is pharmaceuticals. We are overweight compared to BSE 500. Second is discretionary consumption.
Okay.
Right. Discretionary consumption, of course, not talking staples, but, the more luxury or the affluent segments. Third, clearly, if you really ask me, while industrials have gone up a lot, we still seem to have we do have a overweight as far as industrials are concerned. The other one which I think is in for good times is the sector which, you and me represent, which is the non-lending financials. Because whenever we speak financials, a lot of attention goes to banks and NBFCs.
Yes.
But in the last 5 years, you must have noticed that non-lending financials has become a very, very big segment. Everything to do with capital markets, insurance, broking, asset management, depositories, exchanges, RTAs. I think that is a space to also watch out for.
Absolutely. Aashish, there's this one gap, which is one change that has happened. Investing prior to the pandemic and investment post the pandemic. And we've seen a lot of new age investors moving in, and there's a lure towards future and option as well.
Sure.
And the advent of influencers or the Twitter gurus or the Telegram gurus has come in. But there are a few people like you who have been doing this from past many decades would know how a new age, a guy who's coming in who wants to start his investment journey, how should he manage his total portfolio, debt to equity or commodity? How should one look at it in terms of diversification?
So, a lot of people who are, lot of people who have experience like me or, who've been around for long, generally you expect them, they'll always say that don't do this, don't trade, don't. My personal opinion is that you should try out. See, it's like this. Let us say that you are someone who is interested and, you are impressed by, let's say somebody said something about trading options. Somebody says about trading short term, and you're very impressed and you feel that, okay, this person is talking sense. There is a track record. They've made money. So first of all, if you think that whatever information is being given out is genuine and, there is a perspective that the person has and you want to try out, I don't see any harm in trying out, but never bet the house, right? See, if you have 100 rupees, the fact is that 50, 60, 70, 80 will have to be in certain bankable investment options, meaning like, you put some money in a equity mutual fund, you do an SIP, you buy insurance, you do your tax planning. So bulk of your money has to be in stuff which has relatively more bankable outcomes.
Yeah.
And 10-20% you can bet on something which you don't know but you're impressed with. Like, see, I don't think there are very many youngsters who can say with complete authority that I'm going to start writing options and I'm going to make a killing out of it. They might feel that way, but they might lose.
Yeah.
Now, the question whether you will be able to survive or not, the question is whether you bet 100 on it, the entire 100, or you bet 10 or 20. So the point about taking risks is that it's not a strict no to take risks, but you should take risks which you can emerge out of. You should never take a risk which will just throw you out of the playground, right? So I never tell anybody don't do this or don't do that. I would just say that take risks which you can tolerate.
So basically,
you must try it out.
Yeah, basically from your example of 100 rupees, I think 10 to 20 rupees ka risk le lo. 80 rupees should be there in your safe havens where.
Yeah, because see, it's not like people who trade don't make money. It's not like people who write options never make money. Yes, it is speculative, it is risky, but there are techniques and there are things people learn.
Yeah.
The other point is that the earlier in life you lose that 10-20 bucks, it's better for you, right? At least you will have the experience and absolutely move on. But never bet the house. I think that you should not.
Yeah. So coming to my next.
Never bet borrowed money.
Absolutely. That's don't be leveraged specifically in this. Coming to my next question is that there's a data around mutual funds is like average holding period for a normal retail investor is somewhere around 2 to 3 years.
Yeah.
And why, like, you being a fund manager, like, what is your take on this? And if suppose somebody is doing an SIP, what should be the ideal term he should hold this mutual fund? That is also very...
See, there is a perspective to it. Let's understand one thing. Most of the investors are in the system only since last 2-3 years. I'll give you a few examples.
Okay.
See, if we were to meet in 2013, like now you must be reading that, we have like 3.5 or 3.75 crore unique investors.
Yes.
In 2012-13, we had only 70-75 lakh unique investors.
Yes.
Okay. So what does that tell you? That tells you that people have entered only in the last 3-4 years.
Absolutely.
Correct. Second thing, what is the chance? Let's say you meet me and you want to figure out, what is the chance that this guy will remain invested for the next 5 years?
That's very
okay.
Yeah.
So you have to see that how much experience I have. If I have invested in the last 5 years, the probability that I will remain invested in the next 5 years is high.
Yeah.
But if I started 6 months back, what is the probability I will be invested for next 5 years?
Very low.
Low.
Yeah.
So I think that there is a perspective to data. Most people who have entered the mutual fund industry have entered only in the last 4-5 years. Most people who entered our industry are youngsters.
Yeah.
A lot of them may have started investing. A lot of them might want to move out, spend the money. They don't like this fund. They want to try another fund. So I personally don't read too much into this data because the whole culture of investing is not that old.
Yeah.
Look, if you were to do a survey on all the people who invested in 2012, those 75-80 lakh people, how many of them are still in the industry? I would suspect a large proportion of, there's no data on this.
Yeah.
I'm telling you by my experience. All of those, there will be a large proportion of those who are still in the industry.
Okay.
But people who entered in the recent past, they will take time to stabilize. The other important thing is that it's not like the data is, it's not like I'm questioning the merit on the data. The other reason for the data could also be that people don't stick to a fund for too long. It could be that, people invest in the best performing fund of the last couple of years. By the time they have invested, it doesn't remain to be best performing and they flip to something else.
Yeah.
So that thing also can happen. But generally, if you ask me, the larger reason for that data is because everybody is just entered in the last 3-4 years.
Got it. And I think what you said about the funds, a lot of people till 2021 were like attracted towards IT. And what happened since 2022 in IT today?
Yeah, now people must be buying value funds. So it always happens.
Exactly.
Like, in 2020, somebody told me people were buying some funds, international funds, 2021 IT funds, 2022 PSU banking funds.
Yeah.
Nowadays, probably value or contra funds. So it always follows a fact.
Absolutely.
And I think when we manage money, we try to make sure that our portfolio is well balanced and it is not driven just by growth or value or some sector or the other. We ensure that our portfolio is broad and managed for consistency. People cannot stick to a fund because funds are managed for maximum performance or funds are managed in a narrow segment of the market. Whereas we actually make sure that we are not exposed to any narrow segment of the market. We manage funds which are broad and which aim to be a bit more consistent.
I think that's more important because consistency is the key in the market. That's important. Aashish, we have spoken about investing, buying. There's an important factor of this market is selling, because when you don't sell at the right time, you may get caught in the cycle.
Yeah.
So being a fund manager, when do you decide that it is a time to take an exit from this particular script?
So 2 or 3 things I can think of. One is very clear that I hope that people would have, some planning, that what goals are they investing for, what return they are expecting, what risk they can tolerate. Eventually, they should arrive at some asset allocation in terms of how much debt, how much equity. Now, clearly, if your equity investment is giving you a lot of return, then from your desired mix, equity will go up a lot and debt will
come down
less.
Yeah.
On the other hand, if equity market declines, then equity allocation will go down and debt allocation will
Absolutely.
go up. So one is that you should rebalance, right? So one occasion when you take money off the table is when you feel that one asset class has really gone up disproportionate and you want to rebalance. That could be one. Second could be that, let's say you're not this disciplined guy, you're not done much asset allocation and all. Let's say you are predominantly in equity. Even then, long period average, people should expect. I told you last 30 years average is some 13%, right? But the point is that sometimes people make last 3-year return could be 25%, 30%. So those are the times, or let's say not 3 years, but say last 5-year return is like some humongous number.
Yeah.
Then, you should not attribute it to your individual brilliance. You should just think that the market has
Gone. Exactly.
Quite crazy, right? So when you get return much more than what you thought you should have got, that should also
Be one of the factors.
right? Third is, of course, when you need money. I mean, everybody invests for a particular purpose. Yeah. So don't remove money just for the sake of it. If you feel that you've achieved some of your goals, then definitely you have to start exiting. So it has to be either because of some trigger or it has to be because of some occasion. Just because market has gone up or market has gone down, I don't think you should be
Absolutely
playing around.
So basically, I'll put it this way: that suppose you're expecting a 15% return and you have ended up being at 21 or 22%.
Yeah.
You should decide that I've got more than whatever. Absolutely. And then you should go in with your rebalance.
At least it's a trigger for reviewing, no doubt about it.
Yeah. Certainly with many stocks as well.
Absolutely.
I think we have covered almost everything. But I have 2 more questions to ask you that I asked this to everybody, that what advice would you give to a 25-year-old Aashish and who's starting new, fresh in the market? So for our viewers.
Yeah, so I would put it, I would say starting early is most important. See, a lot of time people spend a lot of time to figure out, should I buy this fund? Should I buy this stock? Should I trade this? Should I do that? That's good. I think the key is get started.
Right.
Just get started. And I think if I would have done much better if I had started early. Right? We were just discussing, if you take from 1991 when our economy got liberalized, from there till now, Sensex compounded return is about 12 to 13%.
Yeah.
You know that anything which grows 12% would double in 6 years.
Yeah.
Right. So instead of starting at 25, if I start at 31, there's a 100% difference.
Yes.
In terms of what it could have.
Opportunity cost is high compared to.
So actually, the only thing for everybody, I don't want to say very many things, for everybody, the only thing is start early.
Okay.
Start immediately. The day you have some money, don't need to accumulate like a huge surplus. Mutual funds take as little as $500.
Yeah.
Right? So you just get started. I think that's good enough.
Yeah, I think that's the most important thing. Start early, but do start and start. Like $500 is what you need to start a mutual fund. So Aashish, this was all about the markets. What is Aashish Somaiyaa doing when he's not watching the market? What does he do?
I like to read actually. I like to read. And I like to watch movies. So yeah, that is what. And I like to drive. So these are the things, which I enjoy. Otherwise, I'm not a high maintenance guy, so nothing much.
Absolutely. So any reading recommendation for our viewers?
So I read quite a few different diverse things. So I read broadly in 3 areas. Like for example, one area is self-improvement, as a professional. Other area is about investing. And third is generally anything like politics, etc.
Okay.
I don't read fiction. But I'll give you a few examples. Like one book which I really like is a book called Investing, The Last Liberal Art.
Okay.
It's written by Roger Hagstrom. And that is one book which I really like. Then I like everything written by Adam Grant.
Okay.
Think Again, then Give and Take. I like everything written by, say, for example, Simon Sinek. Like Leaders Eat Last, Start With Why. I like, there's a book called Predictably Irrational, which is written by Dan Ariely. So it's a mix of investing as well as, right now I'm reading a book called CEO Excellence. And then there's another book I'm reading which is called Calling Bullshit.
Okay.
So in this world of information overload where everybody is quoting some random numbers and statistics, like how do you call out? So, reading diverse set of things.
You need to call out bullshit in this age of social media, at least. Absolutely. It was a pleasure talking to you, Aashish, and thank you for answering everything. Viewers, this was Aashish Somaiyaa from Whiteoak Capital. You can see the offerings of Whiteoak Capital listed on ICICI Direct's website, also on Whiteoak's website, and based on your risk appetite and your, thematic investment that you want to do, you can start investing from there. Thank you so much.
Thank you. Thanks for having me.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.